Good morning and welcome to today's session. All lines are in listen-only mode. This event is being recorded and will be made available after the call. If you have any questions during today's program, please type them into the Q&A box located on the lower right-hand side of your screen. Please use the chat feature if you are having technical issues, and a member of the production team will reach out to assist you. With that, I will turn it over to your host, Freddie Mac Director of Single Family Credit Risk Transfer, Jeff Shue. Jeff, the floor is yours.
Thank you, Peggy. And good morning, everyone. Welcome to our ACIS 2021 Recap and 22 Outlook webinar. Always very happy when this one rolls around because it marks the end of the year. We've got the holiday season upon us. But I do realize this is a busy time for everyone. You're staring down the barrel of your 1/1 renewals. And so I think of this webinar as our way of distracting you a bit, giving you an opportunity to step away from that 1/1 work, maybe a little bit of therapeutic break from that. And we'll do our best to be a good distraction for you. We have a 2-hour session scheduled. It is a very familiar structure to what we had last year. We're going to lead off with some opening remarks from Mike Reynolds. He is then followed by, I'll do a recap session and a forward outlook. Sam Khater, our chief economist, as always, a highlight, is joining us. And then we have a panel. It's an analytics discussion, a panel with Charlotte Gladwin, who you know, who runs the Clarity tool here at Freddie. We also have Ben Walker from Aon joining us, and we have Anders Klintoe from PartnerRe. So some mix of internal and external participants today. We hope that you enjoy what we've put together for you. As always, at the end we'll take questions and look forward to that session. So with that, I'd like to introduce Mike Reynolds. He's the Vice President of Credit Risk Transfer. Happy to have him joining us again this year to talk about what's been a very successful year here in the ACIS program. He's the man that knows the context of where we are today. Been around since the beginning of Credit Risk Transfer. He's also in a good mood given the performance of his New England Patriots, which it's great to get him in that. Good thing the Patriots are doing well. It's a different outlook, right? So with that, Mike, I'd like to turn it to you. Thanks for joining us today.
Thank you, Jeff, and thank you everybody for attending. And I echo Jeff's comments that we know this is a very busy time of year for you, so we appreciate you taking some time out. Jeff threw me off with the Patriots comment, but yeah, I am happy, and I definitely want to see a Belichick Brady Super Bowl. I think that would be fantastic. But I totally understand if much of the country would not find that as interesting as Patriots fans do. Hey, we couldn't be happier with our CRT program in 2021. In particular, in our ACIS program, we did more in our ACIS program than we've ever did before. 8.2 billion this year compared to 4.1 billion last year. It's a doubling. It's a massive pickup. It was really just fantastic. And first and foremost, just want to say thank you to all of you for your participation. I think it's been a different kind of year for many different reasons. But we have consistently come to the market, and we've only been able to do that with broad support from the reinsurance marketplace. I am looking forward, as I think many of us are, to when we get to see each other in person again. Hopefully you find these types of virtual events helpful and useful of your time. We've stepped that up to try to mitigate some of what we've lost by not having as many in-person contacts. We're currently for Freddie Mac, we're currently scheduled to return to office in mid-January. Things may always change, but that's our current plan, and I do expect us to resume somewhat normal, although I'm sure there will be restrictions, but somewhat normal business travel again in 2022. So looking forward to seeing folks face to face. I think that's going to be it's missed. These are great, and again we try to structure them the best that we can, but you just can't really replace the actually seeing people and that exchange. So looking forward to that. Won't go into too much detail. Jeff will do the program look back, but we're the largest CRT issuer. We're not the largest MBS guarantor, but we're the largest CRT issuer, and that's because we've had programmatic issuance, very steady support. We've had a few different CEOs now. When I first joined the company in 2012, it was the same year that our former CEO, Don Layton, joined the company. And, Don, if anybody listened to our recent CRT podcast where I interviewed Don, I think he gives great perspective, but he was a very strong supporter for CRT, and absolutely, that's how we're able to grow the program the way we did with his internal support. But since Don left, we had another CEO, David Brickman. David, he was a strong CEO, CRT supporter. David has left, and now Michael DeVito is our CEO, and Michael's a strong CRT supporter. So I think that although we had numerous rule changes in the form of regulatory capital relief, ERCF, the new rule, which was very restrictive in CRT, and I think many of you are familiar with that. I won't spend too much time on that. There are proposals that FHFA has put up for public comment, which improve the economic incentives for us to do CRT, which we think we're supportive of. But throughout, we've been a programmatic issuer, and I think that counts for a lot. I think it's been absolutely very, very good for the company from a risk mitigation standpoint. I think everybody's really happy, as difficult as COVID's been, and it has been extremely difficult in numerous ways, and it will continue to be so. From a guarantor perspective, the losses have really not materialized, and in fact, the economy has performed very robustly. In particular, the housing sector has been very robust. But that wasn't a certainty, and so to have CRT in place as the pandemic started to impact us, that was a massive risk mitigant for us. And then we had very, very largest year ever in terms of new issue guarantor, where we go long on the credit risk. And we've been able to move very substantial amounts of that risk back out into the marketplace. CRT is a primary source of capital reduction, for us. In our state of conservatorship, we have very limited ways that we can balance our risk appetite. We can definitely, retained earnings is one path, but we're not going to issue, common or preferred or sub-debt. The other instruments that may be available, to financial institutions that are not in conservatorship. So we primarily have two levers, in terms of managing the risk that we have collectively on our books. One, we could slow down the acquisitions and what we're guaranteeing on the front end. Or we could do more credit risk transfer on the back end. And we very much prefer to do the second. We very much prefer, our mission is to provide liquidity and stability and affordability to the U.S. residential markets. And so we are here to provide that liquidity. We've had record booming refis, but purchases are growing, and purchases are going to be really big. And you'll hear more from Sam later on the overall state of the economy, but next year is projecting to be a very large year as well. So, transferring risk away from Freddie Mac is it helps protect the U.S. taxpayers. It's been, again, a program that we've been running, not quite a decade. So it's still a relatively new asset class, this particular form of asset class. But we've certainly come a long way, and I think the program has been served well through this pandemic in the sense of the way Freddie Mac's been able to respond as a credit risk manager. The way we've adjusted our forbearance programs, we adjusted our disaster programs, the way we've adjusted this deferred payment plan and applied it, I think speaks to the strength of our credit risk management skills, and to be able to dynamically make those changes and have those economic interest in trying to drive down economic losses, while at the same time looking at the borrower, looking at the neighborhood impacts. We've had solid growth and performance across both of our programs. I will note that in our capital markets programs, we were named Issuer of the Year by Global Capital, so that was a great honor. Losses are very low. We've had 19 transactions with no losses whatsoever. I will, again, just highlight how proud I am of the ACIS program. It's been a fundamental component of our CRT portfolio to have multiple outlets, and that strategy really demonstrated its value this year with the growth in ACIS, the evolving of the standalone ACIS product, which was a tremendous benefit for us. We're able to get to market faster with that standalone execution compared to the previous simultaneous transactions that were linked to the stacker link transactions. So hats off to Jeff and team, and to our broker partners who provide tremendous benefits, and of course to all the markets where we wouldn't be able to do any of this without your participation. I'll just say very quickly, I think folks know that there's been a change of leadership at FHFA. Acting Director Thompson has, pretty immediately taken some steps to endorse or to improve the economics of CRT. I touched on that. There's some public comments out there. I know some of the participants today have made comments back to FHFA. So we see nothing but continued support for that space. ERCF is a different capital regime, and there are some changes that are proposed. What we will continue to do, because so much of the value for CRT is derived based on regulatory capital, we'll continue to look at that, look at those rules, and we'll make adjustments as needed to our CRT programs to reflect what those rule sets are. So just looking forward, before I turn it back to Jeff, looking ahead to next year, you can absolutely count on us to continue to be a programmatic issuer in the space, but not only issuing transactions, but to provide all of the support that we can to help facilitate your involvement, continued involvement, not only on a new issuance, but also to support for outstanding transactions that are already on the books. So we'll continue to do our research reports. We'll continue to do our podcasts, our webcasts. You'll hear later on the panel, our latest updates to Clarity. These are all efforts outside of the specific, deal-related analytics that get provided by the broker-dealers. But these are all the brokers, excuse me. These are all efforts that we want to do to, continue to foster the support of the reinsurance markets, which was our largest year ever. We had, sorry. We had, I think it's 39, Jeff, you can correct me. I think we had like 39 unique investors this year. It's the largest ever. 19 of them were international. also the largest ever. So that's very, very broad support. And we think that's fantastic. So in closing, again, first and last, thank you very much for your participation. Looking forward to seeing you in person. Jeff will talk about it a little bit more later. We are going to do another event on January 5th to kind of kick off the new year. That will be a CRT event, so both Stacker and ACIS participants will be invited. So with that, let me turn it over to you, Jeff, and have a great day. Thank you for your time.
Thanks a lot, Mike. I really appreciate that. And Mike did talk about how we had our basically a doubling in volume this year, and the success that we had through 21, and a little bit about at a senior management level, commitment to CRT and to reinsurance and to ACIS as a product line has remained very consistent through this pandemic environment, through uncertainty related to potential changes with the capital rule, et cetera. So even in the midst of some change, some uncertainty, some volatility, 2021 was a very notable, very successful year, and that has to do with the efforts of the folks yourselves on the line here today. So what I'd like to do is step into our recap a bit. To look at some metrics. These are kind of standard that we've typically look at when we get to the end of the year here. How busy? It was a busy year. I know you all felt it. And how busy? So we're this many years into the platform. You know what to expect from us. We tend to operate on a fairly fast timeline, and did so in 2021 in an effort to manage the risk appetite, the exposures of the company. ACIS was a key component of that, and so what have we done program to date? 8 years in, 77 transactions issued through the program, 26 billion total on pools of 362 billion worth of single family mortgages. So very notable participation of 50 unique participants in our platform. That's grown substantially through the years. That's due to the many efforts around the room here. Always like to call out our broker partners for the work that they do in the market, but also once again to thank those. Oftentimes it comes down to those experienced in mortgage credit, knowledgeable, and sort of landing at a new company. We've seen multiple examples of that throughout the history of the program, where we have a new reinsurance entity writing because of the transfer and exchange of that mortgage credit expertise. So it's very robust participation. We're happy as a buyer to have very active participants in the ability to diversify our exposure. That's key. That's key for us as well. In the next slide, what you'll see is that growth through the years, and very substantial from that first $75 million transaction in 2013 to the 8.2 billion that we accomplished in 2021. And along the way, I think we should take some time to recognize that this success often comes down to the efforts of individuals. And think about getting the program on its feet in 2013. The interactions we had with Sandra Thompson and the efforts she put in as a regulator, and the back and forth that we had with her, developing a comfort level with an industry that we didn't have a lot of familiarity with. So there's a lot to be said, on behalf of or in regard to our current FHFA director, who through the years has been supportive, and happy to see her there and continue that interaction. But in addition, we had Andrew Rippert at Arch in 2013, who was very important to getting that initial transaction off the ground. Everest Re and Trans for the first quota share transaction that really helped pave the way for that platform that we have today to offer both direct and indirect participation. On that point, I would like to take a moment and recognize Dennis Alba, who will be retiring in the coming year, but an individual who's had just understatement, great career, but also an important founding member who will roll off to other great things. But I did want to call out his contributions and thank him. We've had some changes on the ACIS team through the years. Most recently, we had Amy Kim rolling over to Trans Re, but we had the addition of Elvis Micarese coming in to join us from Aon. So all along the way, we've had significant contributions from individuals. I think it's important to kind of step back and recognize all of the efforts around the room. There are too many folks to call out. But we wouldn't be here with 26 billion placement to date without your efforts. On the next slide, you can see a recap of what we did on a transaction level in 21. There's a little typo there in December. That's a SAP 10, which is currently in the market, $769 million high LTV placement. Our approach to 2021 was a very consistent structuring approach, where we did shift a little bit to the spot placements on a standalone basis, where we were delinked from our sister CRT product from Stacker, and we focused more on our SAP transactions to transfer the risk. We had both high and low LTV transactions that were placed in that manner, and it helped us be quick to market. It's well recognized by senior management that ACIS has the ability to get to market very quickly to address our risk appetite and other corporate objectives. So a very, very busy 21, and we're going to roll into the next year. We'll talk about that in the next few slides. On the same sort of basis, working on a independent basis in large scale. On the next slide, just some commentary on how the panel has been supportive through COVID-19, through the outbreak of the pandemic, through 2020, with the initial uncertainty in the outbreak in March. We did have some pause, as we've talked about, in that second quarter of 20, but returned in the third quarter to execute a forward transaction, well supported, mid-teens number of participants on those transactions. And then in 2021, what we've seen is an increase in participation rates. We've got 27, 28 participants, notably on the HQA2 and the SAP 7 transactions. These were our highest ever. And we also had, so for SAP 7, supported by 28 participants on our largest ACIS deal in program history at 1.15 billion. So a lot of notable things to talk about in terms of the scale, but what you saw from us was an effort to maintain consistent structuring approach. We did have the return of the call option later in the year. We had some changes related to loss mitigation expenses. So the most notably, the deferred payment plan was added. The reduction of the B3 coupon. These things that were changes within the familiar structure, so that we were consistent, as a buyer, and we think that approach pays off. So we maintained our presence through the year, and we're able to onboard new reinsurers throughout 2021. On the next slide, a little bit about portfolio performance to date. We did see an increase in delinquency at the outset of the pandemic. The majority of these loans, we've had really good cure rates. The success of the forbearance program and the associated deferred payment plan option to get borrowers back to health has been visible, and we will talk more about that when we get into the analytics section. We're going to show you some slides from our Clarity tool that really demonstrate performance through the crisis. What we've seen on the next slide, what we've seen in terms of credit is continued very strong attributes of the borrower pools that we've been bringing to market. The FICO scores have remained at historic highs. Debt to income ratios have been very solid. What we do see is consistent with reversion to a purchase market given rates, some reversion in those attributes back to pre-pandemic levels, and so similar story for both FICO and DTI, but historically high, strong credit attributes that we continue to bring in our transactions. On the next slide, we'll talk a bit about where we're going to be kind of going forward. What we've done in 21, to my earlier comments, we used the SAP deals, which had historically been used to transfer risk on 15-year loan product. We transitioned to use those on 30-year collateral, and that did allow us the flexibility to make our own decisions around structure, not so much the initial attach and ultimate detach of the transactions. Those are consistent, largely consistent between the two Stacker and ACIS offerings, but mostly the interlayer, attach, detach points, and also on the timing of the transaction. So we have the ability to, once the loans are securitized in a month, to execute a transaction in the following month, and reinsurers have shown the ability to absorb that timeline. Yes, moving fast, but we have been providing the same level of transparency, get the same data tape, etc., to facilitate those transactions. I would expect when we look ahead to 2022, we're going to continue to leverage that standalone format. We're going to use a new series name so that we'll track the SAP deals. Will now be tracked on a high LTV and a low LTV basis. So we'll use the SPH and the SPL series names. And we have some residual exposure from 2021. We stopped with our SAP 10 transaction. We stopped with September of 2021 securitizations, the high LTV component. So we carry exposure on the low LTV component of September into 2022. We'll also have the fourth quarter exposures that are accumulating now that will need to be addressed. So what you should expect to see from us is very early in the year, transactions on par with the size of transactions that we've been doing, at least in early Q1, to address the residual from Q3, as well as what's coming in the door in Q4. To Mike's earlier point, he talked about the impact of the ERCF. We're going to tell you a little bit more about how that affects our buying behavior in our next webinar on January 5th. And so we'll highlight that again. But what you should expect is regular presence in the market, a buying pattern that will exist mostly on a standalone basis, high and low LTV transactions continuing, transactions on a short timeline between when we acquire the loans and when we come out to market with the ACIS transaction, and significant size, volume throughout the course of the year. Once again, we'll talk more about that plan, but we'll have things for you to assess. Data tapes coming your way in the not too distant future on transactions for early Q1. So just a heads up, you've got hopefully a little bit of time to enjoy the holidays. Little Christmas meal for those that observe, and then right back into ACIS transactions in a big way in 2022. So with that, the recap and a little bit on the 2022 expectations, what I'd like to do is turn our attention to Sam Khater, who will join us to talk about his recap and outlook. From I can imagine, Sam, from an economist standpoint, there's been a lot to dig into. An unobserved event like COVID presents a lot of challenges and also a lot of interesting things for an economist to dig into. So we're looking forward to what you have to say and about the recap and about looking forward to 2022 and beyond. So with that, I'd like to welcome Sam Khater, our chief economist. Always happy to have you join, Sam. Appreciate your time.
Thank you, Jeff. I'm very happy to be here with you and the rest of the crew and the audience. I've actually enjoyed these presentations. My first presentation to this audience was via Ben Walker and Joe Monahan about 7 or 8 years ago, and I've always enjoyed this. And you're exactly right. The economy currently is difficult to analyze, so it provides opportunities to use new data and new metrics, and we're going to show that later on in the deck. I've got 6 main points that I'd like to go through very quickly. First, economic growth slowed due to the spread of the Delta variant. Mid-year, closer to August and September was sort of the peak intensity of that. But the economy has been reaccelerating as of mid-November, notwithstanding the latest Omicron variant, which has been in the headlines. The cumulative trajectory of this economic expansion is much higher than the last recession. However, the growth has been very lopsided and tilted towards goods and versus services, and this has really caused issues in our supply chains and caused inflation to really surge. And more importantly, inflation is really broadening across more categories, and this is generating a lot of noise in the press and in policy circles. Turning to the housing market, after a large boom in 2020, housing demand slowed the purchase housing demand slowed in 2021, but it remains elevated, and home price growth hit record highs a couple of months ago. It is beginning to moderate, and we're seeing definite deceleration in home price growth, but pricing pressures remain very, very high. And I'm going to take us through the demand and the supply metrics and prices to sort of talk about that. Looking forward to 2022, all signs really point to a strong housing market with modestly higher rates, high level of home sales activity, and slower but yet elevated home price growth, very elevated actually relative to history pre-COVID. And then lastly, kind of a special topic, which is sort of near and dear to my heart, which is migration, which is a very important longer term topic, but migration has really increased dramatically over the past year and a half since COVID emerged. And we've come up with a way of using our internal data to get a real-time view of migration. And I'll share that with you because I think this has implications for home price growth. So looking to the next slide, on the left-hand side, I've plotted real GDP, the value of all goods and services produced in the US. And on the right-hand side, I've plotted employment. And the way I've plotted both charts is to look at the cumulative movement of economic growth in this expansion versus the prior expansion at time zero, and then what it looks like today versus the last expansion. So if we look on the left-hand side, you can see we had a very large decline of about 9% quarter over quarter in GDP growth. That compares to about in a typical recession, it's 2 to 3% ballpark or so. In the Great Financial Crisis, it was larger than that. It was 4%. But what's very interesting is this recession was very deep, but also very narrow. The recovery was very fast because of the nature of the recession, but also because of the reaction. Policymakers pumped in over several programs, a combined $5 trillion in support, and that's massive. That's about a quarter of GDP. $5 trillion. The economy is a $20 trillion dollar economy. The economy typically rises about 500 to 700 billion a year, and so the scale of the 5 trillion relative to the annual increase is just substantial, and that's really helped lift the economy in aggregate out of the recession and is on a much higher trajectory than the last financial crisis, and it continues to be. We're looking at real-time growth right now, and I'll come to it in a minute, of about 7%, and that's going to carry into next year. So the economy is just on a tear right now in aggregate. However, there are still pockets of weakness. Employment is still one of them. It's actually really interesting because depending on which labor market metric you look at, you can come to a very different conclusion. And kind of going back to Jeff's point about kind of the challenges of navigating the economic data. If you look at employment, it is improving, and we're on a better trajectory most recently over the past quarter or so than the last than the financial crisis. But you can see the difference between GDP and employment. GDP is up 3% since the recession started, whereas employment is down 3%. What's fascinating is if you look at the unemployment data, which I'll come to in a minute. But the strength of the economy is really reflected in the income data. On the left-hand side, I've plotted the cumulative change in personal income, and this includes the fiscal stimulus for the personal income to date, which is the light blue line, versus the last recession. So you can see that income, which typically declines in a recession, not just increased. And you can see each of those minor sort of peaks in income growth is exactly the timing of the stimulus. And so the stimulus really helped lift incomes and the economy out of the recession and caused incomes to grow 10% versus a modest decline of about 2 or 3% in the last recession. If you remove the stimulus, on the right-hand chart, you're left with sort of organic income growth, and you can see it fell and then was flat for about half a year and has really begun to take off as the labor market has improved. Here I wanted to give you a real-time view on the left-hand chart of economic growth. This is a weekly economic index that comes from the New York Fed. And this takes high-frequency weekly data, and it's sort of and I like it because it comes from a variety of sources. So it's got weekly same-store retail sales. It has things like railroad shipments, steel production. So it's covering both kind of the consumer segment, but then also the manufacturing segment of the economy. It's got real shipments. And it's showing right now that while economic growth is slowing down, it's still running at about 7%, much higher than a typical quarter. Typically, the trend growth, underlying trend growth of GDP in the economy is about 2%. So we're running at well over three times that right now in real time. And we'll continue to do that into next year. Notwithstanding my comment that the labor market remains 3% below where it should be. When we look at it from an unemployment rate perspective, unemployment is 4.2%, and we are almost back to normal. And there was just some new data that came out yesterday that said that job quits were 4.2 million, which is a near record rate. Normally, the number of quits in any particular month runs at about 2.8 to 3 million. So there's a lot of churn in the job market. What's also fascinating is the number of unemployed people today is about 11 million. The number of job openings today is 11 million. The number of unemployed people is about 7 million. That ratio of 1.5 to 1 in terms of job openings versus unemployment is the highest it's been the last 2 decades. So you've got this sort of unusual nature and unusual labor dynamics that are happening. And I think part of this is because of the churn and the movement of people as they move across space and across industries. And I'm going to come back to that comment later on when I talk about migration. In the meantime, to try to get a sense of what's happened with all the stimulus income, there's been one sort of prominent study that from JP Morgan that looked at what people did with their stimulus money, and it basically concluded at a high level that a third of the money was saved, a third was spent, and a third was used to pay down debt. So over the next couple of slides, I'm going to try and show you a mosaic that shows that that phenomenon. And so on the left-hand side, I've plotted this is weekly consumer deposit base from the federal government, and you can see that the deposit base has increased by 5 trillion, ballpark about the same as the stimulus, and continues to rise on a faster sort of trajectory than pre-COVID. The savings rate was already high coming into the recession. Typically in a recession, the savings rate is declining and sort of declining under 4. In this case, it was about 7%, and it rose because of the stimulus to, depending on which month that you're looking at, as high as in the mid 30s. It's just in the last couple of months begun to normalize to a more sort of normal level. Also, consumer loans declined by over 100 billion. That's part of the pay down phenomena that we saw from consumers, but now their demand for debt has really begun to rise again. And the other and perhaps more pertinent impact on the consumer balance sheets from your perspective is, what does this mean for financial obligations? And the bottom line is that consumers in aggregate are in the best shape we've seen over the last 4 decades. And I keep saying in aggregate because I am concerned, and there's very little really no real-time data on inequality, but I am concerned that we are seeing a massive rise in inequality, but it's not being captured in these data sets because we don't see the distributions of these things. Nonetheless, in aggregate, the financial consumer balance sheet looks good. On the left-hand side, I've plotted mortgage and consumer debt ratios. This data comes from the Federal Reserve Board. You can see that mortgage debt ratios were already low coming into this recession, and they fell even more. Consumer debt ratios were more normal, kind of relative to history, and have declined in this recession. When you look at the overall financial obligations, so this takes not just mortgage, not consumer, i.e. auto, student, things like that, but also rent. And again, in aggregate, the financial obligations ratio is very low. So the consumer balance sheet is doing quite well. In terms of spending, the other piece of this, consumer spending has just been on a tear, and especially in goods. Because of COVID and the lack of consumer comfort in spending on services and in person, they've really just shifted or substituted their spending and really shifted their spending much more so on goods. This has led to all sorts of inflationary phenomena, which I'll come back to in a minute. But you can see how high goods spending is relative to pre-COVID. It's running about 15% higher. What's really interesting is if I had shown this chart going back in time, what typically happens in a recession is that goods consumption falls more than services. Because in a typical recession, the Fed is uncomfortable with inflation growth. They start to raise rates. Typically, the consumer is already modestly over leveraged, and then the higher rates causes the whole sort of leverage cycle to slow down, and they try and achieve a soft landing, but that never happens, and the economy goes into a recession. And so goods spending, spending on housing, particularly durable goods, housing, cars, appliances, that really cycles down. And so that drags down goods spending much more so than services. And then it begins to bounce back as the economy improves. In this case, services spending declined much more than goods and has been slower to recover. Goods spending has been very high, and that's had a strong impact on inflation. On kind of, when you look on the right hand side, we've plotted services inflation, which is basically sort of on a linear trend up, running at it's ballpark 3% annualized rate. But goods inflation has been just on a tear and has really been driving up the overall inflation rate, which I've got on this chart. The headline inflation is measured by the CPI. It's running at 6.2% for the most recent data. If you strip out the volatile energy and food sectors, it's still elevated, running a shade under 5%. There are many flavors of these inflation indices. One of my favorite ones is what's called the 16% trend mean index by the Federal Reserve. And what they do is, the Bureau of Labor Statistics that calculates the inflation measure, they are tracking the prices of many hundreds of goods and services. And so what the Cleveland Fed does is, for every single month, they stack top to bottom the percent changes in the inflation rate, and they snip out the top 8% and the bottom 8%. I.e., they take out basically the tails, and they take out the cumulative 16% of all those goods and services that are increasing the most or decreasing the most. And it's dynamic. They can change across time. It's not the same goods. And so that measure is the light blue line. And you can see historically it's stable because you're taking out the volatile parts of the distribution. What is concerning about what's happening over the past few months is that the inflation is really broadening. So it's not just in the tails anymore, but the tail is wagging the body of the dog. And this is concerning particularly because shelter inflation is the biggest component of overall CPI. It has about a 34% weight, and the way it's measured, there's a built-in lag in it. And so I expect the rapid run-up in home prices and single-family rents and multifamily rents that have been occurring this year to really begin to drive up that component of inflation. So all else equal, inflation in theory should remain elevated well into 2022 and before it really starts to slow down. Some of these other segments may begin to slow down before then, but shelter, the biggest component, should continue to increase. So I think the inflation story is a story that'll remain front and center for the markets well into next year. Turning to the housing market, I'm going to pick up the pace because I'm going a little bit slow. Home sales were running at about 6 million pre-COVID, surged to about 7.8, 7.9 million as of late 2020, early 21. And then they had a dramatic slowdown. And the main reason there is, rates rose about 30 basis points or so. But it wasn't really that. It was just inventory. The month's supply hit about two months or so. Basically, we were hitting the bottom of the barrel. There was just no product for people to buy. I have a slide on that in a minute. Here you can see the run up in mortgage rates. Here I've plotted mortgage rates, the 30-year fixed rate mortgage versus affordability. The mortgage rate's on the right scale, the affordability is on the left scale, and you can see affordability is elevated. It remains elevated, but it is declining. You can see the modest run up in mortgage rates earlier this year. We're basically running at about 3.31 right now. Affordability has declined to the lowest level since 2008. And you can see what is concerning right now, given the run up in prices, which I'll come back to in a minute, is that today's affordability level is the same as it was in 2018 when mortgage rates were ballpark about 5%, and the same level as 2008 when mortgage rates were ballpark about 6%. So the run up in, the decline in mortgage rates has been capitalized into higher home prices. and is leading to declining affordability. And so this is a main concern of mine right now, and is a longer term concern. But there are other reasons to not doubt the strength of the market, and the main one is a very simple and very fundamental trend, which is that first-time home buyers have been on a tear. A lot of these are millennials. Here I've plotted the employment base for 25 to 34-year-olds versus first-time home buyers. The employment base is on the right-hand side, and the number of Freddie Mac first-time home buyers on the left-hand side. Just to give you a sense of this rise, for 2021, we are running at a rate of about 550,000 first-time home buyers, which is astounding because just 2 years ago in 2019, we were running at about 400,000. In 2015, we were running less than 250. So in the span of 6 years, we've doubled, on a flow basis, the number of first-time home buyers that are coming into the market. If you look at the first-time home buyer share of Freddie's purchase flow, historically running about 30%. Right now, it's running about 45%. So the increase and what's propelling the housing market are millennials. If you take a look at millennials from an age cohort perspective, the three largest age segments in the U.S. are 29-year-olds, 30 and 31-year-olds, and they are moving into their peak home buying years. I've done some research before that showed that peak purchase activity occurs between 32 and 38 years of age. So very strong and fundamental growth. Investor demand is modestly rising. These charts are for institutional buyers on the left-hand side, and their activity has increased. And iBuyers on the left-hand side, iBuyers, Zillow, Zillow has jumped out of the market, but prior to that, Zillow, OfferPad, Open Door. These look like a surge is occurring, but keep in mind the scale. So both of these combined are about 4% of the market. So they are increasing, but it's not a large percentage. And in fact, on the left-hand side, I've plotted the overall investor share of the market, and it is up modestly, but you can see that there's no pop in it, and in fact, it's lower than just a few years ago. It is a little bit, kind of depending on what years you look at. It is higher than the early 2000s, a little bit lower than the peak of the mid 2000s, but there's no surge in there. There's been a modest run up in cash sales as well on the left-hand side. So there is an increase in investor activity, but this is really a story about fundamental demand by millennials, and then the lack of supply. I think you all know this well. Basically, inventory is near record lows on the left-hand side. On the right-hand side, we've plotted the number of renters per available home for sale. There's just a scramble amongst renters to purchase homes, not just from a demographic perspective, but also from my rent is increasing, from a sort of a hedging perspective, right? My rent is increasing. If we look at both single-family or multifamily rents, they're both up over 10% a year. So I think many potential millennials are also looking at it from a cost basis. Hey, I can, instead of paying 10% year-over-year increases on my shelter, I can, if I get a mortgage, I can hedge that. Here, the pricing pressures. Here we've got velocity. This is the percent of homes under sale within 3 days. The absorption rate, they're both near record highs. So pricing pressure remains very high. Home prices hit a record 20% in 2021. They're beginning to decelerate right now, but I fully expect that deceleration to moderate into 2022. Looking at it from a geographic perspective, the growth rate the growth in home. Well, so first of all, blanket comment: home prices are rising rapidly all over the U.S. Let me talk about the ones that are in the less than 15% bucket, which are the light pale yellow. A lot of these are in kind of legacy cities in the Northeast and the Midwest, but a lot of these markets are appreciating at very high rates relative to their own history. So even this lowest appreciating bucket is still, a lot of these cities are +7, +8, +9%, and haven't seen this type of run up in home prices before. And these are the laggards. The ones at the top of the stack are the ones in dark red, and the markets appreciating the most are, a lot of these are in Idaho and kind of the Rocky West. Some are in the Southwest, some parts of Texas, Florida, and the Carolinas. What's fascinating about this home price chart is it exactly mimics a migration chart I'm going to show you, because a lot of this is being driven by migration. So let me take us through sort of these slides very quickly. Here, so what I've done with this data comes from Freddie. And what we've done here is taken a look at for Freddie fundings, their new address that they just purchased versus their old address. And we're looking at this for all purchase fundings for the last 20 years. And here we've plotted only the gateway cities. So New York, LA, San Francisco, DC, Boston, and Miami. And we've basically looked at the ones that, so this is a net figure. And so what that means is we're tracking those that are moving into those cities versus those that are leaving those cities. And by cities, I mean metro, metro area is what I mean. So historically for these cities, they've been losing about 20 to 30, 10 to 30, depending on which year of migrants. What's fascinating is it's pro-cyclical. You can see during the mid 2000, early to mid 2000s, 04, 03, 04, as the home price bubble really got going, more and more people begin to leave, and when the market crashes and becomes more affordable, less people leave. I've done some work on that shows there's a pro-cyclicality as markets become very expensive. They literally start to expel and lose people, and you can see what happened since the beginning of the pandemic. That number has increased 3 or 4-fold, and the latest data point on here is actually September. Even though the label there, it says August, and so and there wasn't a churn. I expected the beginning of a mean reversion, and we still haven't seen it. Actually, we were just running some data yesterday that showed October it still remains very similar to the September level, so no real change. What's fascinating is that was not a surprise. We've heard about that in the press. Here we're seeing kind of real-time validation of it. What's fascinating are these high-flying markets: Denver, Salt Lake City, Austin, Nashville, Raleigh. Historically, migration, strong economies, strong housing markets, drawing people in. What's interesting is in 2017 and 2018, they began to lose people. And I actually did not know that before we started to run this. I expected this chart to remain positive even post-pandemic, just because I thought they were very popular places. And while they are vibrant economies and housing markets, they are beginning to become too expensive. And they're beginning to lose people at a rapid clip. So this was a surprise to me, and just sort of interesting, and just gives you a sense of how affordability is driving migration. So we've talked about where markets are losing folks. Here are the markets that are gaining. The smaller coastal Florida markets, basically any market outside of Miami, is booming from a migration perspective. The blue line, interior California markets, the Central Valley of California, particularly Riverside. Riverside is the #1 inbound market. It's all coming out of LA in terms of migration. And then you've got the mountain regions, and then some of these southern metros, which I'll come back to in a minute. A lot of these are in the Carolinas. There is even some really interesting migration in some of these northeastern areas. So Boston is an area that's losing a lot of people, and it turns out that one of the fastest inbound markets is Worcester, Massachusetts, which is about 50 miles west of Boston. And so, and we see it in the data where there's a flow. It's like just a train of people migrating from Boston into Worcester. And when we look at the price differentials between LA and Riverside, and Boston and Worcester, historically, Worcester and Riverside trailed their larger sort of sibling MSAs by about 1 or 2 percentage points. Since the pandemic occurred, that's flipped, and Riverside and Worcester are appreciating at a faster rate than their 2 sibling cities by about 3 to 5 percentage points, depending on the month that you look at. So there's a very clear relationship in terms of the movement of people away from expensive markets, and it's driving more home price growth in some of these interior markets. This chart just gives us kind of a more comprehensive summary of what I just discussed. And what's interesting is this really looks like an HPA chart, and this chart basically is looking at net migration. And so if the circles are filled in, the yellow, the dark blue and dark yellow, that means they're gaining people. If the circles are empty, that means they're losing people. The blue lines are before pre-COVID, the yellows are post-COVID. So what's interesting is COVID hasn't started any new trains. It's just, at least from a migration perspective, it's just rapidly accelerated. It's just poured gas on pre-existing trends. And you can see all the coastal cities or a lot of the coastal cities, the large, expensive coastal cities, I don't think you can see my mouse, yeah, they're losing folks. In California and Washington in the Northeast, and then you get some in Chicago, Minneapolis, Denver. Basically, every other market is gaining people, and this looks very similar to a home price chart. You're seeing the boom in Florida in terms of home prices. That's due to migration. Boom in the Carolinas, especially South Carolina. That's due to migration. The Southwest, very strong movement in the Southwest and Central Valley. Very quickly, given your interest in climate change, we're also tracking the movement of these folks into climate risk areas. And so here, what we've plotted is FEMA puts out data. We have a climate economist who's tracking this, and she plotted this migration, the same migration data for us by tract using FEMA's designation for moderate to high risk areas. And so here we've plotted the areas that have the highest amount of risk for wildfire, hurricane, and drought. And what's interesting is that most of this migration is moving to areas that have a lot of drought. I mean, some of it is hurricane, but a substantial number are moving into areas that tend to be drier. So one of the flags I've raised internally is we should think a lot more about places. We're talking and thinking a lot about places that get too much water, but we should think about more about the places that don't have enough water. And then one last sort of chart that I thought was interesting related to migration is we've taken a look at two markets that experience a traumatic sort of climate-related event, and just wanted to see what happened to migration in these markets, given that we've developed this data set. On the left-hand side, I plotted New Orleans migration historically over time. You can see Hurricane Katrina. Prior to Katrina, New Orleans was losing a modest number of folks, and then they with Katrina, it led to an outflow of people. But about 18 months later, that migration was done, and the trend didn't really change. It's beginning to change again because of COVID. But it just really demonstrated that people tend to have a short memory when it comes to these disasters. And we see the same things in Chico due to the Camp Fire in 2018, where you get a temporary spike in migration out, but then it mean reverts about a year later. So to conclude, overall, economic growth, employment, and inflation will remain volatile and lopsided until sort of COVID recedes or becomes basically sort of a seasonal virus that we have boosters. For strong purchase demand and record low supply has really driven home prices to record highs. All signs point to a continued strong housing market with modestly higher mortgage rates. I think the biggest risk to this housing forecast is just how much do rates increase. That is by far the biggest concern, because I don't think we're going to get much new supply longer term. And I think demand will remain strong. We've got a demographic tailwind for the next 10 years. So the biggest variable in my mind is what happens to mortgage rates. As I discussed, migration out of large coastal areas remains high and is driving growth in both economic and housing growth in these markets. And the lack of housing supply is a long-term threat to, once we get beyond COVID, how do I say this? I've always felt for a long time, up until a few years ago, that inequality was the biggest threat to the economy. And I still believe that, but housing plays a strong role in that. And I think the reason that one of the reasons why inequality is rapidly rising is that many people are, when we look at the home ownership rates for young people, there's notwithstanding the massive growth rates in first-time home buyers, their home ownership rates still lag their prior generations. And so not only are their home ownership rates lower, but they're buying later, which means they have less time to accumulate that wealth. And housing wealth is the dominant wealth up to the 90th percentile or so of income. So for the overwhelming majority of Americans, it's really all about home equity. And so I think the lack of supply is a threat to that. And another threat of this lack of supply is it's driving people away from the most productive places. The reason San Francisco and Miami and New York are so expensive is that these have very high paying jobs, and these are high paying jobs because these tend to be very productive industries. And if people are moving away from the most productive industries where they can generate the most income because they cannot get affordable housing, then longer term that could lead to a sort of structural decline in the productivity rate of the economic of economic growth. And so this is something I think policymakers should be thinking about. I think housing supply should be front and center as a major, sort of policy topic for us to think about how do we increase supply to make it more affordable for the average consumer to live in the U.S. And so with that, I will stop. And I think I turn it back to Jeff. I wasn't sure, Jeff, who I turned it back to. Thank you for your time.
Yes, you do. Yeah, thank you, Sam. Really appreciate that. Very interesting trends that you're tracking now, and it's the migration patterns, impact of COVID, potential things to watch, and the focus on interest rate paths. And I think it's very interesting that our focus areas have been shifting kind of through as the pandemic has been unfolding, and kind of judging just how much of an impact, how much of a housing event is this. And it's great to have Sam as a resource to help sort of give his input and guidance as we're taking stock of the environment. We do send out on a quarterly basis. Sam's office provides a quarterly outlook, and we have been sending that out. If you're not receiving that, please let us know. But his voice is a very important one. Clearly, the real expert here. And we're happy to have him join today. So thanks again, Sam. And we're gonna with that transition into our analytics panel. I think it flows nicely from an assessment of the macro environment to talk about what it takes really when we're looking at mortgage credit to assess the risk, and not only on our new deals, but if you, as a reinsurer, you've been involved in the program for a few years now, you now have a portfolio that's exposed to the drivers that Sam just highlighted, and that it does take. We don't want to minimize the effort here. It's a lot of effort for a participant to manage that outstanding book of exposures and price new deals. So both to assess the macro environment, house prices, interest rates, where's unemployment, as well as the credit characteristics of our reference pools. That's being done in all through all sorts of environments, right? So in a benign, normal house price, strong house price environment, regardless, those types of activities to take stock of the macro environment and micro environment. And then further, when we get into a period of uncertainty, just like we've seen with COVID, those types of activities are consistent. We're all looking at trying to make an assessment of where house prices, interest rates, unemployment are, but also we have the added layer of how is the business changing? Are there changes to loss mitigation strategies that are developing? So it really takes, highlights again the sufficiency of the information that we're putting out as a buyer. And so they're really when you look at what it takes to manage a book of ACIS exposures, we really kind of think it breaks out into two main categories. It's surveillance and taking stock of the environment for mortgage credit, and then secondly, assessing the go-forward economic prospects of a potential new transaction. And so we're going to talk about that in this panel. How do those activities play out in a typical environment? What tools are you using as a participant? And how do those activities potentially change? What are you doing more of? What are you tracking in a potential environment of uncertainty? So I'm joined today by several of my friends. So I've got Charlotte Gladwin, who's a director, colleague of mine here in credit risk transfer. Also Ben Walker from Aon, senior managing director, and Anders Klintoe, vice president and head of U.S. mortgage at PartnerRe. So I'd like to welcome the panelists. Thank you for participating. And wanted to kind of start to dig into those types of activities, the taking stock or surveillance type activities, as well as taking a go forward view. So as I said, if you are, your participant, as PartnerRe is, that has been building up a portfolio that's now diversified across multiple issuance periods, and you're assessing the risk in that program, we've been as transparent and continue to be as transparent as possible, and offer data to our participant. We leverage a platform that Charlotte manages called the Clarity tool, which aggregates all of this. It's a high volume, right? So we've got a lot of loans involved in our transactions. It's a very large portfolio, to really allow a user a streamlined way to get access and views of the performance of our portfolios, rather than having to pull down bulk data feeds and generate a lot of use code to generate a lot of observations. It's available for you in the tool. That's our primary tool. It's gone through a lot of enhancements. Charlotte's done a great job managing that tool. We know we've got a lot of usage there. So what I wanted to start with is, let's take a look at Clarity as a tool. And Charlotte, we could turn it over to you and ask you to highlight some of the important features that are available for reinsurers as they're trying to take stock of the environment for mortgage credit, and look at things like performance of pools, and then also to talk to you, Ben and Anders, about how you use the tool and some very important things that you can do with the tool. So with that, Charlotte, if you wouldn't mind, I'll hand you the microphone and
Sure.
have you walk through Clarity.
Thank you, Jeff, for including me again this year, and I'm very happy to be here with you. And the timing is actually pretty perfect, because we just had our last Clarity in deployment last week, and we added some functionalities, and very happy that I got the opportunity to show you some of these things. And to echo what you said earlier, is that we take data transparency very seriously. So we always strive to put the best information that we know out there to the market in a timely manner. So as the onset of COVID occurred, we, from a loan level disclosure perspective, we enhanced our disclosure to show the various loss mitigation waterfall, such as when people take out forbearance, or if they're in a repayment plan or trial period before they go into a mod. So we started disclosing that information. And when we introduced the COVID-related payment deferral plan, we quickly reacted to that as well, because we wanted to make sure that our markets had that information at hand. So that's on a loan level side. And to your point, we disclose so much data, and we have so many loans in our pool. It's really a lot of work to be able to digest that. So Clarity serves that purpose, where we take our loan level public disclosures and we aggregate it in a way and show it in a way that's hopefully relevant to when people are doing analysis on the underlying reference pools. So again, the goal is just to provide as much useful information out there, and we take your feedback and enhance the Clarity tool as needed. So from a Clarity perspective, we have, like last year, we had something like 8 releases, which is quite a lot for a tool like this, but it's really to react to the market need at the time. And we continue to enhance it and tweak it here and there over time. So in response to COVID, what we have done, actually, let me show. So what we have done is we added a few dashboards. And just a quick refresher, this is the landing page of Clarity. So what we have done is, the last big release, we created functionality so we can compare the deals easier. So you can compare deals side by side. And also we created these tiles where all the information, let it be if we publish some additional analysis or the podcast information is all on the front page. So we really want Clarity to be a one-stop shop for you to come in and get all the information that you need. So when we added certain dashboards in response to the onset of the pandemic. So one of them is the Delinquency Matrix, and we added another one, which is the Disaster Matrix. Actually, Anders is going to be talking about that in a little bit, so I won't go into too much detail on that one. But looking at a Delinquency Matrix, it's basically taking our monthly reporting, monthly loan level information, and on a month-to-month snapshot basis, we can see different delinquency progressions and performance, different views such as the forbearance, the lowest different borrower assistance plans. We can see whether or not it has taken a payment deferral. We can see the current period payment deferral, prior period payment deferral. There are several different views that you can see to track performance over time. So the limitation of this particular dashboard is that you can only look at it 1 month at a time. So in the last couple of months, what we're working on is it's our first attempt to really show you a view to track this performance over time, because I know we have published a lot of different reports and dashboards and things like that manually to show that how the delinquency level and the forbearance level has trended since the onset of the pandemic. So now we're going to introduce this concept of these performance charts. So this is one of the big enhancements that we have done, is essentially to take the delinquency matrix, which is a one snapshot, per period, but chart them over time, chart those periods over time. So one thing I wanted to know is it's always important to know what pool of loans or what population loans are you looking at. So this is basically every reporting period, the active populations that are still remaining in the reference pools is being plotted here. So in this particular dashboard, this chart, what we are given is various views to track performance. So for example, you can look at D60 plus, D120 plus, D180 plus, and you can look at total delinquency, percent of total forbearance, and you can also see the dollar values for these views. And not only that, you can also group them by the different views that you would like to see. Right now, I have no grouping, so this is showing the entire portfolio that's in our high and low LTV population or deals that are in the actual loss transactions. So as you can see, this is basically charting over time, showing a little bit more pre-pandemic and post-pandemic, how the total delinquency has come down from a portfolio level. Obviously, this, as time goes on, we continue to add new pristine pools into the population. So that also, you should take that into consideration that yes, there is more and more loans being added, and those loans are pristine and they're performing really well. However, in general, it gives you a sense of what the performance trend is in terms of delinquency. And so this is the entire portfolio, but we can also filter to, let's say, pre-COVID deals. And now if you look at the percent of total delinquent, then the trend is still going down, is from the peak of around 8% to now around the 5% range for all the pre-COVID transactions. But keep in mind, again, is that a lot of those loans have paid off. So you don't, even though it's still going down, you're not seeing that effective payoffs. So what we can do is that from a dollar perspective, flipping to the dollar delinquent or dollar forbearance, you see a very steady trend of the performance, meaning that the delinquency and the forbearance has steadily come down from a dollar perspective. And check that again. And I also want to just show that because we have this other view where you can flip it to, let's say, the series year. So now you can compare the series side by side, or you can compare the deal type side by side as well. So that gives you a good level of comparison between the different populations of deals. So there's definitely a lot of different choices that you can make to do some comparison between the cohorts. And also there's another view to show the performance is through this filter. So again, we're looking at the actual loss transactions that are standard high and low LTV. But now I'm limiting the population to the ever forbearance since COVID. So once you select that population, you're looking at all the loans that have taken on forbearance plan since last March timeframe. And just a refresher on our reporting period, it's a little bit lagged for the forbearance. So in the May reporting period is actually looking at the forbearance being taken out in the March timeframe. So if you look at percent forbearance, you see it was starting at 100%, and now, as of the November reporting period, it has come down to about 25%-ish between low and high LTV. However, with COVID, we know that a good portion of the borrowers, they actually start taking out forbearance while they still continue to pay their monthly payments. So we also have this other view to just isolate the forbearance loans that, where the borrower has, stopped paying. So this forbearance and delinquent matrix, you will see that a good bit, especially from the beginning, in the beginning of the onset of the pandemic, you see that actually quite a few people have continued to pay their mortgage as they're taking out forbearance plans. So in this situation where the loans are in forbearance and are delinquent is actually roughly around 20% as of the November reporting. And again, this is all accounting for active loans through each period. So again, there's a lot in these performance charts, and these are just very high level. It just scratches the surface by me showing you this quickly. So I definitely encourage you to take a look and play around with these charts. And especially if you have any questions, please reach out to myself or clarity@freddiemac.com. So there's a second thing that we added is this a new view for transition matrix. So in the past, what we have done is we show you the loan status transitioning from one delinquency to how it rolls to the next period. So that's more of on a delinquency view. However, we are interested to see the status of each loan transitioning from forbearance to other statuses, because right now, I think, we're all very much focused on that. So we added a new view to show you the different workout statuses. So this shows you how a loan would transition out of forbearance. And what I really want to highlight here is really specifically in the active forbearance population. We're still seeing, if the loan is in forbearance, how to transition out, payment deferral is still the primary way for people to exit forbearance. We know that we're starting to hit the 18-month forbearance limit. However, we're continuing to see payment deferral being a predominant method of people resolving their hardship. We do see a slight increase in the loans being modified, and I think that was expected just because as you're, if you miss 18 months worth of payment, sometimes you need a little bit more help, and you will probably need to get something like a flex mod to get a little bit more help on top of the payment deferral can offer. However, I will also want to note the never forbearance population. So in this particular row, you see that very few loans are actually going from never taking out forbearance into active forbearance. And most of that population continue to stay to not ever have forbearance and continue to stay current. And a lot, a significant portion of that has been prepaid as well. So again, it's the same underlying data, but we're just trying to show you different views from delinquency, from different workout statuses. Hopefully that makes it easier for you when you're doing analytics, because certainly from an internal perspective, we also find that very helpful as well. There are a few other changes, and you should have received an email blast to see that highlights all the changes that we have. For example, there's because them into the respective categories. We added filters for different loan statuses, like how delinquent the loans are, mods, payment deferral. We also added filter for MIs, whether or not loan has MI or MI canceled. So just there are bigger enhancements and small little enhancements as well. So the goal is just to make it a little bit easier for all of us to navigate our data. So with that, I'll turn it back to Jeff.
Thank you, Charlotte. And I think it's great timing, right? All the new functionality coming out, it lined up nicely with this webinar. Yep. Nice to be able to do the big reveal here on the ACIS
right.
webinar. So wanted to kind of ask Anders, and I know there's a lot of back and forth, and we always appreciate the input we get from you. Consider you a super user, if you will, of the Clarity tool. So I know that Charlotte's had the benefit of your input and feedback as things are being rolled out, and we'd like to hear, frankly, from our user community. If there are things that you see enhancements that you'd want, please reach out. And Anders, we know you're the super user. Wanted to get a sense from you in terms of what you're typically doing with the tool, and how did that change? What are you looking at in the course of the pandemic that's helpful to you as you're tracking the performance of your portfolio?
Definitely no, and thank you so much, and thank you for putting out this for us. It has, as you said, been a great help for us to have the availability of this data that's so easy to access, especially during the pandemic. One of the first simplest things that was incredible use was the fact that now it's easy to download all the tranche balances and so on from your website directly. It enabled us to, before you had to do a lot of scraping to figure out from the individual reports how much was left of your exposure, which meant you usually reevaluated your portfolio on a quarterly basis. Now that was much, much easier to do on a monthly basis each time the reports came out. So thank you very much for that. Additionally, as Charlotte has now pulled up, this is a great view of, as we looked at the forbearances over time and sort of what happened to the populations of forbearances. So the chart they have up here in the disaster matrix is that we see early nearly no loans in forbearance as the pandemic starts around period 1 here in the graph. You see the populations of loans that are delinquent start to increase, and this is just the forbearance population. But very early on, after like 3 to 4 months after the initial uptake, you already start to see loans transition out of the forbearance program, either through the payment deferral, the light green, but you also see the uptake in pure prepay or loans that just kept paying, that kept remaining current. I think it was so important for us to see the tracking of this is that while you do have loans that transition further into delinquency, the heavy red bar, they're shrinking over time, and none of them, or very, very few of them, are really transitioning into credit events. They're almost all resolving back into a current state, whether that's through prepaid, just naturally occurring, or the payment deferral program. So as you can see, the other bars start to expand. That's been a very, very useful for us to sort of see and keep track of the loans over time.
Very good. So I think the heat map, the disaster matrix, good visual way, right, to kind of track the trends through COVID. The Clarity tool, that's readily available. I know there are, as the situation for COVID was unfolding, you're kind of looking around as a market participant to find sources of information and tracking trends, et cetera. Can you give a sense for what else? I know you got the great Clarity tool there. What other things were you tracking as the pandemic is unfolding? What other sources of information were you looking at? And then, so that's for you, Anders. And then maybe Ben, we could also hear from you, just your understanding of the market more broadly. and what were some things being tracked or trends being tracked in the outbreak of the pandemic?
Yeah, so beyond the standard we had here, one of the things we looked at a lot was Black Knight came out with weekly updates on what they expected their forbearance rates to be, or what they saw as sort of the most live data that was available in the market. So that was very useful. We definitely used all the updates and research we could get from Sam Khater on the website and sort of the projections for where they were seeing it going.
Yep.
Yeah.
Yeah, sorry, Ben.
Well, I was just going to say, I mean, from my perspective, when I think back to kind of if we're retelling some of the COVID era, sort of learnings, I mean, first and foremost, this was an extremely stressful period of time. And the industry, the reinsurance industry and the CRT post-crisis market hadn't really been kind of tested in this way yet. So, the reinsurance community kind of knew something was going to happen, was sort of preparing for what they would do when they needed to sort of be a little bit more reactive to a changing macro environment. But I don't know that anybody, necessarily had this specific scenario in mind. So, I think it was very impressive, how everybody was able to kind of start to wrap their head around things and navigate it as it went. And to the point, Jeff, that you made before, your transparency and data that you kind of released, that you were developing as it went, trying to figure out what things would be useful for investors and reinsurers as, everybody was navigating this together was really helpful. To Andres's point, I think early on, the biggest question marks were around how high unemployment would get to, and what proportion of that unemployment would be, homeowners. As we knew, a lot of the unemployment rate was going to be coming from, service and hospitality sort of industries. And then when forbearance, was known to be kind of an important tool, sort of how would forbearance correlate with the unemployment rate? Would it be 1-for-1? Would it be higher, if there was no kind of proof of financial hardship that had to be kind of shown? There's a lot of uncertainty as to that. So to Andres's point, getting weekly, information from Black Knight and MBA through their surveys and things like that during the early days, it was really helpful for us to see kind of the trajectory of forbearance take-up rates, as well as, kind of get a sense for like where they were peaking out, in the very early days of things. And then, the point around, relying on Sam Khater, as well as, sort of other housing economists, I think was really important. There were a lot of views out there, and it was actually really hard to navigate all of them. But, the housing economists, we found to be extremely helpful, for this specific space. And I think we saw a lot of novel data come out that we hadn't necessarily thought of relying on in the past. Higher frequency data, and Sam's been using more high frequency data in a lot of his discussions. We weren't going out and directly accessing that, but we were certainly thankful that economists were, and were showing us kind of the trends much more real time than we're accustomed to seeing prior to the pandemic.
So you've got multiple voices that are also trying to update their view, and you've got sort of this distribution of potential forward paths that you could look at as you're assessing the risk on your portfolio, and then also a new deal and lands on your desk to evaluate. So how as a reinsurer and a market or a market participant, how do you go about updating the tools that you've got available to do those assessments, right? Obviously, models are extremely important to assessment of risk, return profile, opportunities, and with quite a number of things changing. So you've got the use of certain loss mitigation tools. You've got some distribution in the views around the impact of house prices. Where are interest rates going to go? Are they going to remain low? Where's unemployment headed? What are your views around what it took during the early part of the outbreak of the pandemic on the part of a market participant to do the assessment using existing tools, given the changing environment, you know, and look at their portfolio, and then to really get to a point where they could once again quote a deal, right, and feel comfortable participating in new transactions. What are your thoughts there, Ben?
Yeah, I mean, I think first and foremost, it was trying to figure out what you had in your portfolio and what the potential, you know, set of outcomes could be for that, right? And so trying to get a trajectory on unemployment, understanding how unemployment may or may not drive, you know, sort of your underlying modeling view. You know, we sort of, when we were doing early modeling exercises, you know, we were relying fairly heavily on Moody's scenarios at the time because they were maybe some of the more articulate scenarios that were being put out that had ties back to kind of assumptions around how the pandemic was likely to play out. So you could sort of come up with a view of what the world would look like and then think about how that would affect the, you know, the housing market and kind of run that through the models. But, you know, some of the uncertainties there were sort of how unemployment trajectory would, you know, kind of come out and how that might affect mortgage defaults, as well as, you know, the basically decoupling of unemployment from home prices, the way that probably the models had historically been thought about and trained. You know, that led to potentially some upside, you know, or some not upside risk, some downside risk, you know, to kind of how you're modeling things. But on the other end, you had heavy, you know, response from the Fed, heavy response from the CARES Act, as well as, you know, mitigation tools in place, you know, forbearance, as well as, you know, payment deferral and things like that, that all kind of come into play that hadn't probably historically been modeled. And so what we saw people doing were kind of boxing in ranges of scenarios, you know, to sort of see, you know, how things could play out. And you could do some of this stuff with a paper and pencil, right, to kind of get a first blush view of things. And then, you know, how do you kind of want your models to react to some of these things? I think trying to get, you know, even not a point estimate, but some reasonable range of possibilities and getting a sense of whether your portfolio is largely, you know, kind of in a reasonable spot, you know, that you can explain to your management and underwriting committees, you know, with not certainty, but some reasonable range of certainty was sort of the first step, I think, for most in figuring out kind of how to navigate what was going on and then how to figure out what they could do going forward for taking additional risk on.
Yeah, and so you've got Anders. I know, you know, you're in real time, you know, because we're still looking to buy, right? And then so we've got an active dialogue with you as your you know, at Partner, as we're putting deals in front of you through the ACIS program, and you're actively managing your portfolio. So what were the types of things that you were doing at PartnerRe to adjust your view of the mortgage credit world as things were unfolding?
Yeah, so I think one of the first things that Ben said is we have to take stock of where are we right now before we do anything more. The landscape has significantly changed, so let's figure out exactly where we are right now. And at first, you had to make some assumptions. It's while our data is clean right now, there's barely any delinquent loans, no loans in forbearance. We know this forbearance program is picking up. It's just not being reflected in the data we have yet. So one of the things we did was let's make an assumption about how many of these loans will be in forbearance a month from now and randomly assign a certain percentage and do that at intervals to sort of see what would our losses be if we make these assumptions about the loans now, because we know they're likely to look like this a short period from time. Then also we had to look at the model. So if loans do go into forbearance, we know they're unlikely to default in the next 12 months because they are allowed to not make their payments and there's foreclosure moratoriums. So it was also adjusting the model as, hey, you cannot send these loans through your standard foreclosure process. You have to hold them back. So there's a lot of tweaks you had to make. Also, as been mentioned in regards to sort of the Moody's scenarios, that was very well defined early on in regards to the assumption they made of the pandemic and where they could see house prices go. Prior to the pandemic, they had put out the same sort of scenario, and they really didn't change where they felt these scenarios lay on the distribution. It was just the severity of the scenario. So we went back, looked at our distribution. Are we comfortable where this lies now? And if not, did we tweak our distribution such that it matched better now, or so that we also shifted where we think the likelihood of something is? So I would say that was sort of the first key steps before you could analyze a new deal. And once you were comfortable with the results of that and you felt they're still well within your risk tolerances, then it's sort of, okay, well, what we've learned from this exercise, we can now apply to this new deal and then price it up in the manner that sort of matches what we did to the overall portfolio.
Yeah, and you made an interesting observation as well, and around, so as you're assessing the macro environment, so you've got model adjustments and other things, you changing the way that your sort of the inputs to the model. You made a point in an earlier conversation that we had around on the unemployment patterns that you were seeing. So when this is to Ben's point, an event where you've got some decoupling, right? There's the unemployment shock, and then you look at housing. It's certainly not a housing event, right? And so you've got this interesting relationship between what we're seeing in unemployment and how that's flowing through to home values and the performance on the housing side. But that's an interesting point that you were seeing there in the patterns of unemployment.
Yeah, so one of the things we especially noticed was that sort of the overall employment index was a pretty bad gauge for both the forbearance and overall, because a lot of the people who unfortunately got laid off tended to be service workers or in leisure and hospitality. They were the most hit areas. Those are also populations that have much lower home ownership rates versus others. So we found that by digging into the different unemployment indices, that you could find some that were much more representative of what we were seeing in sort of the uptake in forbearance and how quickly it recovered. That if we narrowed those indices down to more likely homeowners, then you could get a much better view of that. So that was sort of an interesting research we did as a part of that to try and figure out what actually matches here.
And I think it's a good example, a reinsurance shop that has expertise built up through the years, and you're conducting really detailed analysis in the main areas of main drivers of mortgage credit, including unemployment, looking at the distribution of house price growth, looking at various market segments. So now that these things, you've talked about the types of things that you've been tracking. What we know now about the COVID impact on mortgage credit, so we're in a much better position now than we were in that first early quarter, where we were talking about, is there going to be a recession, V-shaped, W-shaped? What's the recovery going to look like? And ultimately, questions around how that would impact housing. We know a lot more today than we did back in early and mid 2020. So you've talked about unemployment and things. What are you tracking now, kind of going forward? Considering what we know about what the impact it's had to date. What are you looking at going forward? Then I'd ask Ben for the same question.
Yep. Should I go first? Yeah. So some of the things we look at now, is Sam Khater touched on it very, very clearly in his presentation. He can say it much better than I can, but it's the supply-demand balance. We're seeing this huge push from the demand side of the millennials that want to move in, buy housing, but we're also seeing the limited supply of housing that's coming up, especially around the first-time home buyers and sort of the more affordable housing segment. So that is some of the things we're tracking a lot. We don't see it changing anytime soon because it's hard to bring on significant amount of supply, and the demand isn't going away. Obviously, we track interest rates a lot. Not only is it projection of the affordability of the future book, but also how quickly our current exposure will run off. So those are some of the key points definitely we're tracking.
Thank you. Maybe Ben, your take on what market participants are tracking going forward?
Yeah, I think it's still a lot of the same traditional type things, the things Anders talked about. I mean, even before the pandemic, and then at the very early stage of the pandemic, even when some of the projections were for home prices to go down, you were still sort of like, well, there's still this supply-demand imbalance. I know we were questioning whether the real estate industry would be able to actually transact, which may have affected kind of how home prices were thought of. But the supply demand and the demographic trends, are things that we're tracking, kind of, I think the industry is keeping an eye on. There's been really strong home price appreciation. So the question is that, fundamentally driven, or is that, kind of something else going on there? And I think, if you're keeping track of those things as well as affordability, you can kind of get a better gauge for, are we okay with a really strong HPA year because it's driven by things that we can point to and understand versus sort of exuberance or, kind of overstretching of borrowers. So it's similar things, but I think with a kind of a different light now.
Okay. Yeah. I think we've had a good look. Thank you. I appreciate your all the views here, Anders. The look at how what analytics you're conducting, what you're looking at, what you're tracking at Partner. Ben, the sort of more broad look at the reinsurance segment in your comments, and I think and also wanted to thank Charlotte as well. The look at clarity, we'd encourage folks on the line, use that tool. It's there, available. We're here for any questions you have on that. But I'd like to thank the panel and conclude this segment, analytics segment. Appreciate you participating. Thank you. We're going to now transition into the Q&A segment. And I believe, I'm going to hand the microphone over to Cass Ramirez to cover Q&A from the audience.
Thank you, Jeff. We will now be taking questions. As a reminder, this session is being recorded and will be made available after the event. If you have questions, please enter them into the Q&A box located on the right-hand side of your screen. Your opinion is important to us. Please take a moment to complete the survey, which you will also find on the right-hand side of your screen. We appreciate your feedback. With that, let's go to our first question. This first question is for Jeff. Is the implementation of ERCF going to have an impact on structuring?
Thank you, Cass. We did touch on that, at least mentioned the potential impacts that Mike Reynolds also indicated. It's something that we're, we have, obviously the new regulatory capital framework taking effect, real reporting requirements, and now a greater focus on ERCF and leaving the 2018 CCF behind. This year, there's been a lot of work and communication back and forth with FHFA, and that those standards around ERCF are they're currently taking. They took feedback in a follow-up round on ERCF. So the business is has retrained its focus on this new regulatory capital framework. And then the question is, to what extent is that capital framework going to drive changes in structuring and et cetera? Obviously, we're using CRT to manage capital. And so when, with the change to the new ERCF requirements, there's certainly a reassessment, even down to, structuring, et cetera. You will hear more from us in our upcoming webinar in January, more specifically about the impacts. But clearly, ERCF has a higher capital requirement than the 2018 rule. And so you might expect that we would, as a buyer, sort of follow that requirement up, and you may see some higher detaching M layers, if you will, the upper layers. So we'll talk more specifically about that. I will say the speed to market that we have on the ACIS side is helpful for managing this higher capital requirement, in that when we onboard a new pool of loans, we take a full capital charge on that pool until that pool makes its way into a CRT. So we are incentivized, and with the ERCF being a higher capital threshold, even more so, even more important to maintain that speed to market. So that's going to certainly keep a focus on the length of the execution timeframes and keeping those short.
Thank you
Cass.
so
What
much.
else?
Thank you. Actually, we have a few for Sam, and one of them specifically refers to slide 14, so we'll pull that up for reference. The question is, I thought 2 quarters of GDP contraction in a row was the definition of a recession. On slide 14, left exhibit applies Q sub 0 leading to GFC when a quarter is down and then up, and then the fall. Seems misaligned, making the comparison highlighted in green off to me. When did definition around starting point of recession or the recessions change?
Yeah, so great question. Very technical, very good question. So the recession began in February of 2020, so it split the quarter. Unlike the last recession, financial crisis, which began in December, so it was a cleaner cut. So I think what we did here is we rounded up in terms of moving a line to the right. But you're right, optically, it does make sense to have the line that basically move that dashed line over and align so that you see a 2-quarter drop because that is exactly correct. But I think what happened in this case is since the recession began mid-quarter, we just moved it up. But you're a great catch and absolutely right. We should and I'll make that edit and move the line to the left.
Thanks, Sam. The next question is for you as well. What are the major contributing factors for the limited housing supply, and how will these factors change going forward?
Yeah, they're varied. So the first one, the builder, I've talked a lot to the builders about this. The biggest one for them has been the labor shortage, and this is pre-pandemic. I mean, if you look at the labor supply in the construction industry, it's been growing slowly for the last few years. Many contractors and construction workers fell out of the last recession, out of the industry, and never came back. Many of them went into the home remodeling industry or into commercial or apartment. And they really never came back to the residential, which tends to pay less than some of the others. So labor has been an issue for them. And also the age structure of the construction market has just gotten older as a result. And their wages, I've actually argued for some time that it's not a labor shortage, it's a wage shortage. They're just not, and I think when the builders hear that, they just sort of stiffen their necks and say, well, okay, if you think we've got a housing shortage now, wait till we increase wages, because that's just going to flow right into home prices. So labor is clearly a big one, and immigration and immigration policy is tied to that. There's a substantial share of the construction employment base that are immigrants. And so that's, one way to potentially kind of play from a policy perspective, have a release valve. Another is that, and related to it, which is the capacity of the industry is just constrained. Many home builders went out of business in the last recession. The construction industry, while, there are a few kind of very well-known large construction firms like Toll, D.R. Horton, it's really still dominated by the middle and smaller builders. And many of these went out of business and never came back. Another is on the lending side, AD&C, acquisition development and construction lending, the risk weightings became much tougher. And so many banks became more gun shy about putting those loans on their balance sheets. And so I think that's an issue. One of the kind of thoughts I've floated out there is that we've got a secondary market for land and structure where it's combined. What if we, is there credence to potentially developing a secondary market for land to help support and provide more liquidity? There's very little data on this, but if you look at rates, the interest rates for loans on land, they're much higher than they are for land and structure. And in theory, the land is what appreciates. it provides the most of the appreciation technically for a home. The structure is depreciating the whole time, unless you're putting in a lot of improvement. But the structure is depreciating. The land is heavily appreciating, and so the home price, which is the bundle of the two, is increasing. And then lastly, there's zoning, which has gotten a lot of attention. There's no doubt zoning has an impact. And with zoning, all you really need is just a modest increase in density. I'm not talking about high towers, but more, duplexes, triplexes, all the mosaic of kind of the middle housing that's missing. And you're seeing a move there in markets like Portland and Minneapolis and some parts of California, but it doesn't seem to have had much of an impact yet.
All right, so one more for you, Sam. How do you see work from home or remote work impacting housing migration patterns?
Oh, I think that's the main reason why you're seeing the migration of homeowners to these secondary and tertiary markets. And to me, this is a big deal because it's basically an arbitrage opportunity. All right. I mean, I actually had that opportunity in the mid 2000s. I was looking at a job at the Federal Reserve Bank of Atlanta, and I was surprised at the time. I was working at Fannie Mae, and even though I was a real estate economist, I was shocked at just when I went out looking at houses. It's one thing to see a market that's more affordable on paper. It's another thing to visually see a very large house that's much nicer than one I live in. That's half the price, and so it's a massive arbitrage opportunity for many of these folks. And I think longer term, it's hard to raise people's incomes. It's easier to cut costs, and I think this is one of the reasons why you're seeing migration even pre-COVID to the South and Southwest, because it's just a lower cost base market for employees and technically employers. And so I think the longer we remain in this remote world, I mean, Jeffries just yesterday asked people to kind of work from home again. The more that these behaviors become more permanent and they ossify and calcify in place. And so, but I view this as an opportunity for not just companies to reduce their costs, but also to give something to their employees. In a sense, you can raise their standard of living. It's a big deal. I view this as it's one of these Pareto optimal welfare enhancing moves that's good for everyone, generally speaking. So I think there will be pressure, and I think this will come from employees themselves, because you're clearly seeing a lot of churn. Like I mentioned before, quits are at a very high rate. And I think people are really, I think the COVID really opened up people's mind. They had more time on their hands to think about their families and their career, and I think they're taking more chances around their career and chasing other opportunities if they don't get what they want.
Thank you, Sam. And with about a minute or two to spare, we have time for one more question. I just want to remind the audience, if you can, please take the survey located on the right-hand side of your screen, because your opinion is important to us. So the last question I have is for Mike. With Fannie Mae back in the market, is there concern of oversupply in 2022?
Thank you, Cass. I think you just threw that to me to be nice to me, so I had something to say. I appreciate it. Yes, there is some concern. I think we have to look at that. As we've discussed a couple times, the acquisition volumes, the guarantee volumes that we're doing are tremendous. And Fannie Mae is doing a similar type of level. And as we move into a purchase money market, you'll see, that's probably going to be pushing up the amount of credit protection that we're getting, and there may be other factors along those lines as well. That said, so those are the headwinds, if you will, in Fannie. Fannie's back at the market. That said, I think we have some tailwinds. First of all, since the very beginning of the program, we have always been very conscious about not bringing too much supply to the market, or the flip side, demanding, or just not coming out too much. And Fannie has always exercised that discretion as well. So I'm very confident that we'll continue to do that. What we'll also see is we have a number of transactions that have been locked out related to COVID delinquencies. And as those clear up, the transactions will start cash flowing, and we're going to see some good pay downs next year. As well as our buyback programs, primarily on the capital market side, we'll be exercising those, so that'll be putting some cash back into the market. we'll continue to do exercise real likely. We can't commit to it until we get there, but there's a number of call options that we have on the ACIS side. So I think there's definitely some tailwinds that will help offset some of the increased demand that we're projecting for 2022. But yeah, we're gonna have to keep on working with you all to get lines in your books, as well as to continue to expand to see if we can get new players into the marketplace.
Thank you, and back to you, Jeff.
Thanks, Cass. So I can picture people virtually putting on their jackets, but before you go, wanted to thank you for attending today. Wanted to thank our speakers. Right, so we had a wide range here. We wanted to spark, get information out, some information about next year, but we do have a webinar coming up, and that's on the next slide on January 5th. This would be a joint discussion, so it's CRT writ large. So you'll have Christian Valencia joining myself and Mike Reynolds. He runs the Stacker program, so we'll talk about at a broad level CRT, talk about Stacker and ACIS objectives in the year ahead. So I think that's an important one we wanted to flag for you. You will see an invitation coming out very soon for that January 5th session. So once again, thank you for joining us. We intend to be, we're scheduled to be back in the office early in 2022. We'd like the opportunity to host you if you're interested, coming down to visit us in Tysons. It'd be great to see you sometime out the road in 2022. Hopefully. Thanks again for the support of the program this year. We accomplished a lot together. I'm looking forward to more in 2022. So all the best to you and yours during the holidays, and I look forward to seeing you soon. Thank you.